All right, let's go ahead and get into it. And Lisa Lang, we should activate her camera for telling me what a nice job I always do. So, but again, anybody who wants to activate their camera, at the very least, interactivity in the chat. So I got something to react to this week. But let's go ahead and get into it. So the week that was in the mortgage industry, a lot of reports that came out this week, really fueling off last Friday's tough talk from Fed Chair Jerome Powell. Sent the markets into a tizzy. The stock market really got crushed. Powell setting the stage really for, what he described as a very tough and long fight against inflation that's going to have impact on the broader economy. Not surprisingly, stockholders and stocks traded off accordingly. As it relates to our industry, the mortgage bond market also kind of reacted negatively as well. And, the reason for that is, we've said it before in this show ad nauseum, everything with our industry and with interest rates right now is fueling off of inflation. And when you got the Fed chair that comes out and has some very tough comments about their commitment to utilize all the tools at their disposal, not good news for mortgage bond investors or holders, right? Dan Holtz of Sovereign Lending Group. Dan, you're on mute. You're on mute.
No, definitely not good news for them. So, this market's crazy. It doesn't know what it wants, right? As we can see with the fluctuation of everything that's happening right now with the price. Hopefully the market finds out where it wants to be soon so we can get back to some type of stability, which is what we want in the mortgage market.
Stability in the mortgage market?
Isn't it? I can totally get it. Well, we're so used to never knowing what's coming down the market. It is nice to know at least what pricing would be like.
I say it all the time, leaders in our industry, really, it's tough to be a leader in our industry because of the constant amount of change, the variables out of the control of leaders like yourself, Dan. If it's the government policy, interest rate policy, what's going on with housing inventory and some of the broader things on housing stock in America. Difficult, right? To run a company with so many variables. It can be great like it was the last couple of years, but it's a roller coaster to be sure.
Rich, I joke with my friends. I'm like, if you step out of the mortgage industry for like 3 months and you come back, it's like a new world. Everything's changed. Everything's different. The product offering, the market, the rates. It's like, what happened? So that's why you always got to stay into it. You hop out. It's like a whirlwind trying to get back into it too. So, but it makes you quick on your feet. You got to continue to be adjusting. Seeing what what the customer wants, what's new for them, what different products you can offer them to provide about value and a benefit for them. And so it makes it exciting. It's not for everybody, to say the least. It's always changing, moving. If you like that, that's what mortgage is all about.
Amen. And let me take this opportunity to introduce our co-host this week, the co-founder, vice president of Sovereign Lending Group out of Costa Mesa, California, Dan Holtz. Dan, thanks for joining me in the co-pilot seat this week.
Hey, Rich, I really appreciate you having me on the show. Looking forward to it. I love listening to you guys. So it's actually fun now to be on it with you and be able to talk mortgage.
Awesome. If you could tell us just a little bit about Sovereign, a little level set for the audience, a little bit about the company and size, scope, and all that good stuff.
Yeah, corporate headquarters located in Costa Mesa, California. We were founded with me and my business partner, who actually was a college roommate, back in 2005. Opened the doors in 2006. Started out as a broker shop, moved up to become an independent mortgage bank sometime right around 2012. And just been enjoying the mortgage market ever since. We have been ranked for 10 years straight by Inc. 5000 as one of the fastest privately held companies too, and that's an accolade that we hold here true to ourselves, and we're very excited about that. And that's really all about the team members here that's allowed us to be able to be recognized 10 years in a row by that, and all the hardworking Americans that we help out too. So Sovereign Lending Group, since 2005 all the way up to about this time last year, was a focus on consumer direct mortgage activities. We're licensed in 45 different states. We have every single product that's out there to deliver to our clients. But about 12 months ago, we did bolt on retail. So we have retail teams now. We have offices in Northern California. We have offices in Hawaii, Nevada, Arizona, Texas, and we're looking really to expand that more than traditional route to, along with keeping our focus on consumer direct, which is very true and due to me and my partner's heart. But again, retail is fantastic. We're really enjoying it. With all this changes happening in the market, with these rates and big companies going out of business and this inflation, it's really created an opportunity if you have a great setup, a great platform, a great value proposition to do some serious talent upgrades, to really acquire some seasoned, great retail bankers and consumer direct bankers add to your team. And that's exactly what we're doing right now. We're really focusing on really getting the best out there and giving them the tools so they can serve their clients and give them what they need to help as many hardworking Americans as possible. And that's really what we're built about. And that's what we do every single day.
Good stuff, Dan. Thanks for sharing that with us. And let's go ahead and continue to navigate through all the latest news of the last week. And there was 2 reports that came out recently. One this morning, I didn't even have a chance to share it with you. It was essentially Goldman Sachs, one of their lead financial analysts that put out a piece, something about housing still has further to fall. At the same time, there was a pretty vast survey done by Consumer Affairs recently that indicated that 84% of Gen Zers are eagerly waiting for home prices to come down a little bit, indicating a very robust kind of shadow inventory of buyers out there on the market. Dan, would love to just kind of start the meat of the show by getting your general perspective on where we are right now with housing. It's certainly an interesting time for housing in America.
Yeah, no, that's a great point. And those obviously are very respectable institutions coming out with their findings of what they think may be happening. And really, realistically, no one knows what's going to happen. But yes, higher interest rates make higher payments, which brings down affordability. But what I can tell you too is that there's not enough inventory, right? There still needs to be more homes built. There still needs to be more places for these Gen Zers to start their families and things like that too. So until inventory catches up, I don't see major housing correction in terms of price or value for that matter. What I do see is more of a normalization of the market where we see their traditional appreciation to 4%, not what we've been seeing for the past 24 months too. So maybe pockets of falling real estate, but overall, again, there's not enough homes built to see something that happened in 2008. And that's in my opinion.
There's obviously there's no easy fix or answer to the whole housing inventory issue in America, but you got to start somewhere. I mean, how do you eat that elephant? I mean, it is, I think that we have a vast shortage of affordable starter homes in America, and somewhere it's going to start to have even more broad, real impact on the broader economy, no?
I agree. And really what it is, and for any business out there, if you're a business owner, for me as a business owner, for the home builder, we like stability. We like to be able to project and understand what's going to happen 12, 24 months out, right? So that does make it challenging when, we have the government, moving interest rates so quickly up and down. That creates confusion. We don't know what's going to happen. So it's very hard to plan out. Obviously, government regulation is another factor that rolls into that too. So if we can work on those 2 facets and give a kind of a better understanding of what may happen in the future and more constant, then I think we could plan better. We could make sure that housing inventory comes to the market. But again, that's a long stretch, obviously, in the federal government to understand that and to kind of do what they need to do on that part too. But until that happens, you just got to be very quick on your feet. And that's what this home builder are trying to do and trying to understand what's going to happen in the next 12 to 24 months. Are rates going to go even higher than they are now? Is that going to destroy basically all the homes they've been working on for the past 12 months? But again, if we can, have some type of stability would be the key in anything. And obviously reducing the government regulation in terms of the permit process, the cost process of bringing these new homes to the market.
That piece of it alone, I mean, when you we don't like to get political on this show, but as it relates to the 2 major political parties in America, their views on housing could not be more different. And for the Mortgage Collaborative as an organization of mortgage lenders nationally, or somebody like you that is an owner of a company, it's it's a lot to deal with. I mean, it's like right now we've had the Biden administration in for a couple of years, and they're implementing and deploying a lot of the people and the tactics to achieve what they're looking to achieve out of housing. But if they get smacked in the midterm elections in November, it's going to make it almost impossible to get anything done. And then, if the other side were to win the election in a couple of years, it's like we go back to the CFPB with just, the shadow employees. And so it's wild. I can't think of many other industries where who's in office just leads to just really violent day-to-day business operation changes for business owners.
I agree. And same thing with us. Like, again, stability is what we like. Now, knowing what's going to happen, it makes your plan, your strategic objectives, your 3 to 5 year goal out easier to navigate. But again, knowing what party's going to be in office, that is definitely something that you have to, as a business owner, take into consideration on how you make your decisions on what your growth pattern is going to be, because they are different and they have different effects, from the taxation to the regulation aspect of things and everything that comes with that too. So it's, again, another one where you got to be on your toes. It's one of those factors, like we said at the beginning of the conversation, you got to watch out for, and you got to navigate through it too. But same thing with the home builders. They have to understand that part too and navigate through that too, to get to where they want to be.
This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by the co-founder, vice president, Sovereign Lending Group, Dan Holtz. Dan, the consumer direct side of the business and your business, how's that just been in general? I mean, what we've been hearing from other members, it's tough. Obviously, a lot of people going after a lesser amount of loans. You guys diversified your business by opening some retail offices. I've had some other members do the same, but that side of the business, different challenges from traditional retail, but I gotta imagine it's been tough this year as well, no?
Yeah, 100%. And consumer direct is, very usually heavy on the refinance, and that is obviously seen it take down even more than the purchase level too. And really for us, what it's all about is getting back to the basics, right? Being able to offer that value proposition to our clients, whether it's a cash out loan and whether it's a line of credit. Not a lot of rate reduction here, but there's a lot of equity. And there's a lot of inflation. Having credit card usage is almost at an all-time high. So there's definitely a need for cash. Now, are you having the right client that needs to have that? And are you able to present that to it? And do you have the right banker on the other line? It's not 2020, 2021 where we're just order taking. You need to be able to go and educate your client, be able to show them, the outcomes, how to get to a better place. And really, it's a lot of seasoned vets have seen these markets before that are doing well. A lot of the guys have never seen, a rate in the 5% zone, let alone 6% zone. They're going through some real quick learning curves, or I've seen a lot of people get out of the business too. And quite frankly, that needs to kind of happen right now. There's too much capacity in the marketplace right now. There's too much mortgage machines, too many originators to support what the need is right now. And again, we see this is another cycle. We saw this after Brexit in 2016. And 2017 was okay. 2018 for most mortgage banks was not fun. Again, we're experiencing that now. We're probably going to experience it a little worse than 2018 due to the fact that rates were so low for such a low period of time. And it's going to hurt a little bit longer than it did in 18. And it's the natural thing that needs to happen. Darwinism, whatever you want to call it, where the survival of the fittest wins. But that's happening right now. We even see it with our sales tour, our bankers. Guys can't make it, moving out of the industry, trying other things. And the guys that are doing well and know how to navigate the market, their production is definitely lower, but they're still helping a lot of clients out and a lot of people with home ownership.
Excellent historical perspective from a guy that's been through a couple of these cycles. And it's funny talking to different leaders that have been in the industry for varying amounts of times. They're varying perspectives on what we're going through now, but I think you just laid it out very well right there. And we remember, 2018, I remember was a very, very tough year. I remember our winter 2018 conference being just memorably depressing. Not depressing, our conferences are always uplifting, but it was a very tough time for the industry and a lot of very tough talk about cost cutting and maybe some lenders that wish that had done it a little bit earlier. To your point, we've got too much excess in the marketplace right now, and
Yeah.
it's been exasperated by a couple of things. One of them you touched on was rates were so low for so long. The drop off in business is more so than your typical refi boom to off cycle. And then secondly, as well, we've got also the fact that so many people, you get the people that have already refinanced, and then yet there was so much profit margin in the business for 2 years too. So the
Yeah.
war chest of that lender that is thinking, do I, I'm losing money. How many months am I going to lose money in a row? Am I going to sell? Am I going to give up? Like the war chests were beefed up, and that's part of the reason we got some additional excess still right now, right?
And I agree with you. And a perfect example is the top three wholesalers, right? They're in a massive battle right now. They're doing loans basically that make no money for them, right? I guess they're praying maybe the MSRs down the line will pay off on those two. But again, the top three wholesalers right now are just battling it out in terms of price. And we've seen this beforehand. They do this every cycle. This is like nothing new. Like this is not every time volumes drop, they need to feed the machine, so they drop their profit margin. You can only do that for so long where you're doing loans for no money, where someone says, all right, fine, and it kind of returns to a normal market. So that's definitely happening out there. Again, the sporadic of the bond market too, right? It's very difficult to talk to a client last Thursday about possibly buying a home, thinking about refinance. They call back today, and now the bonds move, like where the bond market has moved so much where now it's affecting that ability for them to qualify for that payment or take that cash out too. So there's definitely a lot of headwinds. There's definitely a lot of companies that have big war chests that will be reading through that. It's going to take time. That's what always happens. But I can tell you that the individuals that do weather the storm, the companies that do weather the storm, will come out when it turns. It always turns. It will get better. And the guys that are still in, the girls that are still in, companies are still in, they're gonna take it at that particular point, and that's what we plan to do too. So we're running smart business. We're doing talent upgrades. We're bringing additional team players to our team that fit our core values, that want to work hard and serve the client. Because again, you can do that now. You weren't able to do that in 2020, 2021. But now as an opportunity, if you're sitting right, and when that does change, the market does change, you should be able to capitalize on it. When does it change? I don't know. That's the $1 million question I think we all ask ourselves every single day.
So been some not so rosy, optimistic episodes in the last week in Mortgage Today. So it's great and refreshing to hear from a leader that's been through a lot of business cycles, that expanding and growing your business and really looking at this as an opportunity. So yeah, kudos to you guys. You touched on the wholesale price, whereas I wanted to touch on that with you as well. Just been entertaining theater this year, watching the three big wholesale lenders up in Michigan just kind of go after. You got some broker offices. I mean, it's that climate right now is just kind of crazy because again, you got companies that made a ton of money. A lot of them went public, and they're like you said, they're betting on the MSR thing. I mean, United Wholesale stayed profitable these last couple of quarters because of MSR marks. But that's a little bit of a dangerous game. That used to be my world. You have that scenario where rates like live in the force, and you still get some payoff, but you don't get the refi boom, and you don't get the new purchase boom, and the MSR piece can get crushed too.
I agree too, and to add another component to how crazy this market is and how difficult it is to operate. A lot of the other lenders too, like they know, they're scared to pay heavy rebates to do free loans right now, right? So most of the loans that we're doing you have to pay 2-point cost to get those loans because, again, as a lender, and I totally understand, like I'm not going to buy servicing rights for it to run off the book in 12 months, right? And I know a lot of economic forecasters are thinking rates will go down here in the next, 6-12 months. Who knows if that happens or not? But again, if you do all these loans this year at 6.25, and I'll run up your books next year, they don't want that. And that's what a lot of them think is going to happen. So they're offering not a lot of rebate to do these loans. So the consumer has to pay for it up front, which obviously makes it less valuable for a client possibly to refinance to. More headwinds, obviously.
There's no silver bullet, especially with the GSEs, really through kind of charter paying most lenders roughly the same price for assets that they're buying. Same with pools that end up at Ginnie. there's a level playing field for small and big lenders from a price perspective. Obviously, some advantages of scale as you continue to get bigger and grow that can increase your efficiency and push down the cost to originate. But when you see companies, because we've heard so much of that from our members this year, like this is irrational, or this company's offering this, it makes no sense, or they're doing this, or they're doing that. Companies can do that until they can't do that. No, there's no company that can do all those things and have no ramifications to it. And like anything, it's a gamble. It's a business development gamble, right? We're going to discount our pricing, or we're going to pay all those out the nose bonuses in the hopes that, we get it back in the long game. What's your history been just with that and that type of stuff?
Well, again, and it's a lot of it, like you said, is a gamble, right? And because no one knows what's going to happen in the marketplace. And we've gambled a few times, meaning that we thought like, hey, we think rates will continue its downward slope, and it didn't happen. So again, for us, hiring a bunch of employees, bringing more team members on, and for the bond to go the other direction up 80 bits, whatever the case might be. And now that need for refinancing is less, and you have too much capacity here at the company, right? So you right size it, you try to do it quickly, because if you don't, you can bleed through a lot of cash, and you don't pray and hope, well, hey, the market's going to get better, whatever the case might be. But again, if it goes the other way and you did all these things, well, then you're ahead of everybody else, and you're able to capitalize on that too. So whether it's hiring, having your team members, maybe buying these MSRs, like what some of these guys are doing too. It's just super hard to forecast what's going to happen. But if you hit it right, you look like a genius, right? But if you don't, you're kicking yourself in the butt, because realistically, you're blowing through your own cash, which is never a fun feeling by any means, too. So, I get that point.
This is the last week in mortgage today. I'm Rich Swerbinski with the Mortgage Collaborative. I have a couple minutes left with the co-founder, vice president, Sovereign Lending Group, Dan Holtz. And Dan, going back to the aforementioned survey of prospective home buyers in America, trying to end on a positive note with some interesting stats from it. 78% feel like a housing crash, defined by home values dropping from their current levels by more than 5% is coming. So 78% of prospective home buyers feel like home values in America will fall off by more than 5%. 84% of Gen Z respondents felt the same. 3/4 of all respondents in the survey said they've socked away to cash to snatch up a house if prices drop, and have saved on average $29,500 for a home purchase. Gen Z respondents, however, had the smallest balance of cash on hand for a home, about $15,000 on average. And then one of the outcomes and thoughts of the report is, that if the housing bubble does burst, that home prices come down, that Gen Z younger buyers are still going to really be in a tough spot, because you have a lot of slightly older, slightly more well-off home buyers poised to jump on homes. So it goes back to what we were talking about at the beginning of the show. A lot of young people that want to buy homes, and it doesn't feel like there's a path for affordable housing inventory to it all even come close to satiating that demand.
Yeah, and we have this conversation a lot. Again, the media is always looking for headlines, right? Negativity is what they usually go for, right? So they can have a negative housing markets coming out, prices, they're going to definitely report and talk a lot to that, which unfortunately a lot of our homeowners are listening to that and may give them faulty information, right? Too. So again, we tell our clients, I tell my clients, I personally believe, is if you are willing and able to buy a home right now, you don't own a home, you should probably do it. Yeah, there are the chance that maybe home values may go down, but I think there's a higher likelihood they may go up, right? And especially if you don't own a home. If you're an investor, you want to gamble a little bit on that part, so be it. But again, if you're a first-time home buyer, you don't own a home, there's nothing like having that home. You're part of the community. You have that tax deduction. You have the ability now to possibly to participate in that appreciation, which most likely home values will be higher in 5 years from now, will most likely be higher in 10 years from now. So again, if it's a long-term play, I think if you can, you get in now, because again, values traditionally have gone up. Maybe they may, when they go down 5% next year, possibly. Is that going to happen? No one knows. But again, I think the tax benefit and the ability for someone to be in their house now outweighs it. They should move if they can do that.
10 years ago, Dan, the median home sale price in America 10 years ago, 228,000. Today, 440,000. So proof in the pudding, your statement, home ownership, the best way to build and safest way to build wealth in America. And, even if home prices come down a few percent from where they are right now, if you're a current homeowner, that's gravy. You've seen a lot of appreciation. If you're a new prospective home buyer, I still see a lot of demand out there in the marketplace that I think is a good portender for home values going forward. So,
And I agree. And what's the alternative? Rent, right? And that's just continued to going up. So, at least if you do buy a home, you can lock in that payment and know what it should be for the next 30 years if you decide to go with that product. But rents, it's amazing to see some of these rental rates too. It's mind boggling how much is being asked for some rentals at this particular time. So again, just another reason why I'm a firm believer in home ownership. There's so many benefits on it for the possibility maybe of going down. Again, I don't think it's worth that. Like again, being what those things I just said.
you guys been doing it at Sovereign Lending Group since 2005. Dan, really appreciate you joining me. You're USC Trojans this year, football prospects. Yeah, what's your going into the season?
I think we're ranked, I believe, in the top 15 through the AP, so that's looking good. We've been had a lot of changes out with our coaches and things like that too. So hopefully it's a new start for us, and we show well. So I'll definitely be going to some of the games. It's always fun to get back on campus, right in my undergrad studies at. So it'll be a very good time.
Good stuff. And to our attendees, thanks as always for taking 30 minutes of your week out with us here with the Last Week in Mortgage Today. We're here live on Zoom every Tuesday at 2 p.m. Eastern. Then we're on YouTube after live, where a lot of you watch, and where the majority of you digest the show on podcast. So if you're one of our podcast listeners still listening, join the live broadcasts Tuesdays at 2. They're fun, pretty interactive, and we have a lot of fun with it. So until next week, have a great rest of the week, everyone. And thanks again, Dan.
Everyone, appreciate it.
Thank you, guys.
All right.